Hello, everyone, and welcome to Teaching University. In this lecture today, we're going to be discussing index funds. And this is a great course for beginners because if you're not familiar with index funds, this is a great little lecture on helping you understand index funds, how they work, and really the benefits of index fund or passive investing. And even if you're an experienced investor, this is a great little refresher course on index funds. And sometimes it's always good to revisit the basics because sometimes we tend to overcomplicate our investment strategies, and this is again a great little way just to keep things simple when it comes to how we approach investing in the U.S. stock market. So a lot of the material we're going to be covering today comes from John C. Bogle's book, The Little Book of Common Sense Investing, and this is part of the Little Book Finance series, where it's a series of different various books covering various aspects of investing and finance. And it's a great series. I recommend you collect these books over time. There's just a treasure trove of wisdom in each one of these books, especially in Bogle's book. And for those of you who don't know who John Bogle is, he's a founder of Vanguard Investments. He's also one of the pioneers of index investing. And he's cut in the same cloth as a Warren Buffett or Charlie Munger or Benjamin Graham, who is the father of value investing. And Bogle's a big advocate of this buy and hold strategy of investing in great companies. And of course, in this case, just buying a piece of the entire U.S. stock market as a whole. And it's, as you'll see here throughout many of the slides in this lecture, that it's a very simple but powerful strategy to be able to grow your wealth in the long term. So for those of you who don't know what an index fund is, and this term is from Investopedia, an index mutual fund or ETF tracks the performance of a specific market benchmark or index, like the popular S&P 500 index, as closely as possible. That's why you may hear people refer to indexing as a passive investment strategy. Instead of hand selecting which stocks or bonds the fund will hold, the fund's manager buys all or a representative sample of the stocks or bonds in the index it tracks. So essentially, you're just buying a piece of the entire U.S. stock market, or the S&P 500, which is your 500 largest companies, or NASDAQ, or you can buy an index fund in a particular industry like energy, for example. You can buy an index fund on particular commodities as well. So there's a lot of different ways you can be able to tap into buying a piece of the entire U.S. stock market or segments of it. And rather than buying individual stocks or bonds, which can be a lot more work, it's better just to invest in index funds and just, put money in there and watch it grow over time. And it's overly simplistic, but as you'll see, there's a lot of power in this strategy when it comes to just buying a piece or an index of the entire U.S. stock market. It's a much more effective strategy in the long term in growing your wealth. So this is a quote from the book, and this is a little story here, which is a great little fable. We're at a party given by a billionaire on Shelter Island. Kurt Vonnegut informs his pal Joseph Heller that their host, a hedge fund manager, had made more money in a single day than Heller had earned from his wildly popular novel Catch-22 over its whole history. Heller responds, "Yes, but I have something he will never have. Enough." And this is a great story because the underlying theme here is really the problem that so many investors have, is that it's this obsession, or really this more and more mentality where it never seems enough. We can never have enough money. We need to have more because we got to buy more material goods and possessions. And a lot of what drives this behavior, as Charlie Munger said in a speech that he gave recently, it's not greed that drives this erratic behavior, but envy. We have to have more than the next guy, and that leads to very erratic behavior when it comes to our investment strategy. And again, for those of you who don't know who Kurt Vonnegut or Joseph Heller is, Kurt Vonnegut wrote Slaughterhouse-Five and a number of other books, and is cut in the same cloth as like a Hunter S. Thompson, and is again considered one of the greatest writers of the 20th century. Joseph Heller is in that same boat, who wrote this novel Catch-22, which is a great book, again, one of the greatest books ever written in the 20th century, which is kind of an ironic twist on World War II. It's a book that I have to revisit myself now that I just reminded myself of this. But anyway, it's this more and more mentality where we're obsessing with beating the market. The problem is that the vast majority of investors fail to do so because we don't have an effective strategy that we can stick with long term that can help us get phenomenal results in our portfolio. We try different things. If we see that we're not making money, we lose money, we get discouraged, so we try the next best thing or next best strategy. And it's this back and forth that over time leads to this erratic gambling-like behavior. Unfortunately, the stock market has been labeled by some as like a casino where Investors just throw money in there and just hoping to see where their money goes, and they want that next quick fix. The dream that a lot of investors have, or traders who think more short term, is that they buy a penny stock and then the next day the penny stock is like $10 or $20 and they're instant millionaires. And we saw this mentality also back in 2008 during the U.S. financial crisis, where you had homeowners who basically took out loans without really much of a credit check or income verification. They purchased multiple homes thinking they were going to be instant millionaires. And of course, we all saw what happened. After that, the rest is history, where the U.S. economy crashed, and it was the greatest economic crisis since the Great Depression. So it's this gambling like behavior, this more and more mentality that leads us to make very big mistakes and causes us to lose money. And this is where the financial industry has convinced so many people that investing is too complicated, that you need financial professionals to help you. And that's where mutual funds come in, which are just managed funds that you can invest in that are managed by portfolio managers. But we could see that with mutual funds, the vast majority of them really struggle to beat the market, or beat, like in this example here, the S&P 500. You can see that the vast majority of funds, whether large cap or mid or small cap, vast majority of them fail to beat the market in the long term. And of course, when you add the fees on top of that are tacked on to investing in mutual funds, we could see that investing in a mutual fund in the long term may not be the best strategy when you consider that many of them fail to beat the market and the costs associated with them. So the simple fact is that selecting a mutual fund that will outpace the stock market over the long term is, using Cervantes' wonderful observation, like looking for a needle in the haystack. So I offer you Bogle's corollary. Don't look for the needle in the haystack, just buy the haystack. So what we're saying here is that rather than purchasing or investing in individual stocks, which can take a lot of work, and if you don't have the time, then it's better just to invest in the U.S. economy as a whole, the U.S. stock market. So as Bogle says, the winning formula for success in investing is owning the entire stock market through an index fund and then doing nothing, just stay the course. Again, overly simple, but sometimes the simplest solution is usually the best one. Again, we overcomplicate this strategy. We overcomplicate investing in the stock market and making money. We think we have to use this complicated trading strategy, and really we tend to just make this a lot more difficult for us than it has to be. By keeping it simple, we can earn long-term financial gains and grow our wealth and portfolio in the long term. So again, to borrow this chart from Bogle's book, if you would have invested, for example, $10,000 in an S&P 500 index, say going back to 1926, by 2016, your portfolio, through the total S&P return and with dividends reinvested, it would have grown to $59 million. Now you may be saying, well, Frank, that's great, but I don't want to be like 9,000 years old by the time I can take advantage of my portfolio growing over the long term. But consider that if you keep investing money and put money into this index fund over time and keep contributing over time, you can grow your wealth a lot faster, and this accelerates in the long term. But you can see the power index fund investing, that this buy and hold strategy, just buying a piece of the entire U.S. stock market, you reap the benefits of the growth of the U.S. economy thanks to innovation and economic ingenuity. So the message is clear. In the long run, stock returns depend almost entirely on the reality of the investment returns earned by our corporations. The perception of investors reflected by the speculative returns counts for little. It is economics that controls long-term equity returns. Emotions, so dominant in the short term, dissolve. And again, we can get overly emotional when it comes to investing because we tend to look at the short term and forget about the economics of investing, and really how economics plays a huge role when it comes to investment returns. That ultimately it's supply and demand, it's economic growth, and it's the value that many of our best companies provide in the marketplace that determines investment returns in the long run. And a very good example is like Starbucks and Apple. Not only do they provide great products and services, they've become, or the way they've branded themselves, they've become ingrained in the consciousness of the global consumer. When you think of coffee, you think of Starbucks. When you think of computers, you think of Apple. And that's really a testament to not only the quality of their products and services, but also how they branded themselves and how they've been ingrained in the consciousness of the consumer thanks to great marketing and the great products and services that they provide. That makes them really some great companies to invest in. in the long term. And again, just as a disclaimer, these are not this is not investment advice. Obviously, it's your responsibility to do your own research and homework, and you are responsible for any gains or losses that you have in your portfolio. So just a very quick disclaimer there before you think I'm giving you investment advice. I'm using Starbucks and Apple as an example for educational purposes. So anyway, so Graham's timeless lesson, again, Benjamin Graham, the father of value investing and the mentor of Warren Buffett and Charlie Munger and other great investors, is that Graham's timeless lesson for the intelligent investor, as valid today as when he prescribed it in his first edition, is clear. The real money in investment will have to be made, as most of it has been made in the past, not out of buying and selling, but of owning and holding securities, receiving interest and dividends and increases in value. So the way to approach investing is really as an entrepreneur, that you want to own a piece of a great company that offers great products and services, that has great financials, that has great revenue, that has lots of cash, that has a durable competitive advantage, where there's not many competitors that can compete in that space, that has branded itself well with its consumers. And also, if you're not looking to hold individual securities, why not invest in the entire US economy as a whole that captures all these great companies that are out there, that are solving problems and are contributing to the marketplace and are making the lives of consumers better? But this could be very challenging because unfortunately we tend to have a short-term horizon, as I've said several times before, and our perceptions get clouded by the moment. And when you turn on the news, there's nothing but negativity. And as of the making of this lecture, obviously there's inflation and the higher gas prices, there's the fear of economic recession, there's the war in Ukraine, political division, there's all this stuff happening out there. And it tends to cloud our judgment, especially for the long term, what makes it harder for us to develop a long-term strategy to grow our wealth, because we think the world's gone to hell in a handbasket, why even bother? But what we look at, for example, with COVID, during the shutdowns, again, many of us thought this was going to be a way of life. This was going to be a persistent problem where, we were just going to be locked up in our homes for the rest of our lives. That's what it seemed like. But eventually, thanks to innovation, we were able to develop vaccines that were able to save the lives of millions of people. And because of that, the pandemic eventually receded and we were able to get our lives back and the world has reopened. And of course, this is something I never thought would have happened just as I'm making this lecture a few years ago during the shutdowns. So we tend to really have our judgment clouded by what happens in the short term. It's important to remember that whatever problems we're facing right now eventually can be resolved. And really, it's during times of economic volatility and discontent where innovation and really opportunities come into play, where you can take advantage of new problems that can be solved by developing products and services. And the U.S. economy gives us that opportunity where during discontent, there's new innovations that come out that can contribute to the growth of the U.S. economy by providing jobs and new products and services that can make our lives better. And it just makes sense then that you want to take part of that growth in the long term, which, as you could see, can yield very handsome benefits to your portfolio.